In this video, I show you why the savings and investment number you think you need in retirement might be too high.
Holy Schmidt!
If you're new to the channel, hi, my name is Jeff. I'm a CPA turned author turned public speaker. I'm also the creator of the course Social Security Simplified. I started this channel in 2020 really at the request of my daughter. She saw me helping family members out with their own financial information, and she said, "Dad, the world is going through a rough time right now. Can't you help others as well?" And with that, the channel was born. Today we have over 450,000 subscribers, over 80 million views, over 1,000 videos, and we would love it if you join our YouTube family. Simply click subscribe and turn on notifications, and you'll get alerted the next time we post a video. We post 3 or 4 times a week. We all have those moments where something someone said to us in the past sticks with us. Maybe it was a passing comment. Maybe it was just the expression on someone's face in a room where you were a silent bystander. One of them for me was as a first-year student at Kellogg, Northwestern University's MBA program. I was in a finance class, and the professor said, there are 2 things about finance that you need to know. The first is that some information will always be true. 1 + 1 will always equal 2. But most of what you're going to learn here is directional. It's a best guess, and it will be refined, maybe even change completely over time. There are a lot of things in finance that are a best guess, like the direction of the stock market, and knowing which is which will make a big difference in your life. That statement is even more true today than it was back then, because back then there might have been 5 or 6 good sources of financial information. Today there are thousands of data points out there from thousands of places. And that information, by the way, sometimes gets diluted and changed when it passes from person to person by text, email, a blog post, etc. So right now, I'm going to get really clear about an opinion survey that somehow has been converted into a fact survey. Not by the publishers, they're completely clear about what the survey's purpose is, but by people using the information. Northwestern Mutual runs an annual study called the Planning in Progress Study. In the 2026 edition, released on April 1st, Americans said they would need $1.46 million to retire comfortably. That's up $200,000, by the way, from the previous year. It was $1.26 million in 2025's survey. Now, to be completely clear here, Northwestern isn't saying that this is the Rosetta Stone of finance and you need to follow the rules here. They're saying that this is an opinion survey. They're completely clear on that. But the data on this survey circulates and it becomes a target for a lot of people, despite the fact that the survey numbers themselves went up 16% year over year and inflation was up 2.8%. So how do you validate the information for your situation? By doing the arithmetic yourself using government data, unbiased government data. The Bureau of Labor Statistics surveys household spending. In the 2024 Consumer Expenditure Survey, households headed by someone aged 65 to 74 spent an average of $65,354 a year. For all households 65 and older, the figure actually dropped to $61,432. So now you know what the averages are. It's an interesting data point, but you need to do something with that information. The next thing you do is subtract the income that arrives into your home, whether you have an investment portfolio or not, Social Security. For this example, the SSA's 2026 fact sheet says that a household couple receives $3,208 per month on average. That's $38,496 a year. And of course, in both these instances, you would replace your number with the numbers that represent you. So in this example, the gap you need to cover here is $65,354 minus $38,496, or about $26,858 a year. At a 4% withdrawal rate using the 4% rule, that's a balance of $671,000. If you multiply $671,000 times 4%, you come up with about the same number. And to be super clear, the point here is not that $671,000 is your number. It's that the number in your head probably, likely, could be too high based on information that you're just reading about out there in the world. Your actual number needs to come from your own spending and your own benefits and other predictable cash flow. So how do you determine your number? Well, first and foremost, your number needs to be built around your life, not an average out there somewhere. And one really important point, a lot of numbers are built based on someone's working life budget, not their retirement budget. Two completely different things. Many retirement savings numbers are built the same way. You take the number that you think you need in a given year, let's say it's $80,000, and you divide that by 4%. That's $2 million. The math is the math. 1 plus 1 will always equal 2, and $80,000 divided by 4% will always equal $2 million. But the problem isn't in the math. It's in the number at the top of the fraction, because most people start with how they're spending now, and how they spend now isn't how they're going to spend in retirement. Look at what disappears once you go into retirement: the commute, the work clothes. For a lot of people, taking a family of 3, 4, 5 people on vacation. And most importantly, the retirement savings number itself. Because when you go into retirement, you stop saving for retirement. Payroll taxes go too at 7.65% up to the wage cap, but of course that only goes away if you stop working. When you add all of these up, the work-life budget can drastically overstate the retirement budget. That, by the way, is why the households that are 65 to 74 spend an average of $65,000. But if you go back one category, ages 55 to 64, they spend $86,440. The difference is $21,000 by going into retirement. So how do you tackle this? Well, you look at your spending and you take 12 months of actual spending and you lay it out on a spreadsheet, and then you start eliminating the things that will go away in retirement. Now, does it really matter to get this accurate? It does. And the reason is because if your spending number is off by $10,000, using the 4% rule, that's $250,000 more in savings and investments that you need. And one adjustment that goes the other way: most retirees spend more per year in their first 3 to 5 years of retirement because they have a backlog of things that they need to do. So spending will actually be more, and then it slows down after that. So write down two numbers. The first is your steady state number, and the other is an adjustment for the first 3 to 5 years of retirement. And the difference goes into a cash account where you can draw from it during your initial retirement years. Point number 3, understand that the balance is pre-tax, but most people, when they enter retirement, their tax rate goes down. Here are the numbers for 2026. The standard deduction is $32,200 for a married couple filing jointly and $16,100 for a single filer. If you are 65 or older, or you and your partner are each 65 or older, add $1,650 per person. That brings a couple to $35,500. On top of that, for tax years 2025 through 2028, there's an additional deduction for people 65 and older of $6,000 per qualifying person, or $12,000 for a couple. But understand that this additional $6,000 deduction, $12,000 per couple, starts to disappear at an income level of $150,000. So when you stack all of these deductions, currently available anyway, together, a couple receives $47,500 in deductions. Then you look at the tax brackets. The 12% bracket, for example, is $100,800 for a couple. Add on top of that the deductions that we just talked about. This means that a couple can draw $148,000 and still stay in the 12% tax bracket. When you stack that against the average withdrawal rate from savings and investments, $26,858, you can see that you have a lot of headroom. If you're still doing your finances on spreadsheet, you're doing it the old-fashioned way. On this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. This is the personal financial planning software that I personally use. With Bolden, you can run forecasts and run your plan through optimistic, average, or pessimistic assumptions. You can look at Roth conversions. You can explore the best way forward with your Roth conversions. You can create up to 10 different what-if scenarios. You can create withdrawal strategies, and you can create a must-spend, like-to-spend budget. A lot of the things that we're talking about here. If this is of interest to you, you can use our affiliate code. Simply go to go.bolden.com/Schmidt. Get your 2 weeks free. After that, it's just $12 a month paid annually if you decide to keep it. There's also one area where the number actually needs to be larger and where people overshoot the mark, and that's healthcare. Medicare starts at age 65. If you retire at 60, 62, that's 3 to 5 years of health insurance you need to pay for yourself. From 2021 through 2025, enhanced premium tax credits capped what marketplace enrollees paid at 8.5% of household income with no upper income limit. Those enhanced credits expired on December 31st, 2025. Under 2026, the original rules are back. Premium tax credits measure income from 100% to 400% of the federal poverty level If you're above 400%, the credit is zero. For 2026, 400% of the federal poverty line in most states anyway is $62,600. For a family of four, it's $128,600. Now here's where the overshoot happens. For most people retiring before age 65, they estimate the full unsubsidized premium amount. And where do they think they're going to pay for that from? Their IRA. And that creates a very large withdrawal number. But the cliff is a test on modified adjusted gross income, not on your net worth. And modified adjusted gross income depends on which account you draw from and how much. A Roth withdrawal doesn't raise it. Neither does spending cash or the return of your own basis in a taxable account like a brokerage account. So a retiree with a mix of accounts can often stay underneath the threshold and get the full credit. And the action step on this point, by the way, is super clear. Price your own actual plan in your county with the income level that you anticipate, and you can get your number. Then look at which accounts you can draw from to see if you can reduce that number. The next point is you need to be reasonably flexible with your approach because of something called sequence of return risk. Sequence of return risk is something we talk about a lot on this channel. It basically means that you can take two people, put them side by side. They can both have the same average return. Someone has low average returns at the beginning of their retirement. The other has low average return at the end of their retirement. And the first person will come out behind the second person if everything else is equal. The reason is that person number one needs to sell more shares to fund their life, and when the market returns, they'll have less shares to grow. Overlay that with the fact that people tend to spend more in early retirement anyway, and you can see how this could be a problem that you need to at least pay attention to. Now, one of the potential solutions anyway is having more cash, 1 to 2 years of cash set aside, so that if you retire into a bad market, you can stop selling from your investment accounts and start using cash. The next point is when you actually claim Social Security, whether you claim it early, you claim it at full retirement age, or you claim it late. Now, most people look at the decision on when to claim separate from the amount that they're going to withdraw, but the two decisions are tied to one another. To use an example, if your full retirement age was age 67 and you claimed at age 62, you get 70% of your full retirement age benefit. If you claim at full retirement age, you get 100% of your benefit, full retirement age. If you claim at age 70, you get 124% of your benefit. The difference between age 62 and age 70 is a 77% increase. On a $2,400 primary insurance amount, that's roughly $1,680 a month at age 62 and $2,976 a month at age 70. The difference is $1,296 a month. Now, when you translate that into portfolio terms, that's $15,552 a year. At a 4% withdrawal rate, replacing $15,552 a year would require $389,000 more in your portfolio. Now, this is an illustration, not a recommendation. When to claim Social Security is a very personal decision, and a lot of times it is more about the other benefits, like the survivor benefit and what you plan on doing in retirement, than the actual number. But if you're talking about just the math, that is the difference in the size of your portfolio, assuming a 4% withdrawal rate. The other point is inflation. Your Social Security payment is adjusted for inflation every year for the rest of your life. When you raise the size of the payment, you raise the floor and your portfolio carries less risk. And again, delaying isn't for everybody. A health condition that shortens your expected horizon changes the answer. So does cash flow now rather than selling into a bad market. And there are many other reasons to delay or claim early. This is a data point for you to examine as you look at your overall picture. Now, this last point is what I call the are you really, really sure point. And that is that people who are close to retirement don't stop. They need to make doubly sure that they hit the number that they need to hit. A recession gets discussed, so they wait. Someone mentions long-term care, so they add a cushion. And each reason is defensible on its own, but when you start stacking them, the finish line becomes a treadmill. If you like this video, check out that video, the #1 Social Security math rule that most people misunderstand. Also, don't forget to check out Bolden. Go to go.bolden.com/Schmidt to get your 2 weeks free. This is Jeff Schmidt, and I will see you in that video right there.